About some of those stocks we've already talked about, the banks, QBE, the general sort of feeling about reporting season so far?
Specifically talking the banks and QBE, as I've talked about in the last 2 years, the banks have almost in the eye of a storm, really. We've had this property bubble that's yet to burst in Australia, that's burst everywhere else. And you've got a company like CBA, as Scott noted, announcing $7 billion, amazing $7 billion profit, when they've got $350 billion in residential property loans on their books, which is stuck in a property bubble. So I'd be very loath to touch a bank at all, despite their profit-making machine at the moment, because I think the risks are just so substantial that if you think property is overvalued, which I certainly do, or overpriced, then you've got a huge issue with the banks, and that leads forward also to QBE. And I've been critical of QBE for a reasonably sort of shortish time, but QBE is one of Australia's largest mortgage insurers, so they take the first risk pretty much on every time somebody borrows more than 80% of the price of a property. QBE or Genworth will wrap that 80% in mortgage insurance. So QBE's subsidiary, which is a QBE LMI, I think it's called, is incredibly exposed to the property market as well. And that's not really factored into QBE share price at all. I don't think they've obviously had operational issues that have caused the share price to be smashed from 30 down to 13. But the inherent riskiness of QBE LMI is massive. And I don't think the market fully appreciates that.
Okay, I want to just take your comment about either Westfield or some of those other results. Echo, perhaps?
Oh, just on Westfield, I agree with what both Scott and Peter said. It's a remarkably well-run company and has been since 1956 when Frank Lowy and John Saunders started. If you look at any company that should be struggling, it should be Westfield, who's exposed to commercial property, and the move online should be hitting commercial rents. And I walked down our office on Clarendon Street in Melbourne, a reasonably fashionable Melbourne suburb in South Melbourne, and there's empty shops everywhere. Yet Westfield just ekes out year after year of strong performance. Obviously they're off their highs pre-GFC, but it's still just been a remarkable performance. And Frank Lowy is obviously grossly overpaid because he doesn't need the money, and there's no reason why he should be getting $15 million a year. But kudos to him and his sons, because they run a remarkably tight ship there.
Yeah, extraordinary. All right, we're going to take a short break, and we're going to thank Peter Esho from News this week, and of course BHP Billiton, which is reporting next week. It's turning quite gloomy. Adam Schwab, I'll come to you first. I mean, they're saying on Thursday that they're continuing to focus on cutting back their spending and that jobs could well go. Now, this comes on the back of quite a bit of gloomy talk out of BHP.
Yeah, and I've been pretty critical about BHP for about, two years plus now, and the plaudits that Kloppers was getting early in his tenure for being this youngest ever McKinsey partner and such a smart bloke, I think proves the problem that sometimes smart blokes shouldn't be running companies, and it's possibly the less academic and the school of hard knocks that get the best results. And Frank Lowy, who we were just talking about, great example, because the mistakes that have been made by BHP management, obviously the biggest mistake ever was merging with Billiton, which cost about $30 billion.
But you can't blame that on Marius.
I'm not at all, but obviously Marius has done some pretty bad blunders from Potash to Rio to a bunch of other things that haven't been well executed. And ultimately, as we've discussed in the past, the role of a CEO of a company of BHP's ilk is not to dig iron ore out of the ground. The mines are well and truly established before Mario entered the executive boardroom. All Marius has to do is allocate capital effectively, and in that regard it's been a complete and utter failure. Every capital allocation move he's done has been pretty much wrong, and it's not just Marius. He's got a team of people all being paid $5 million plus, and it delivered atrocious results. And of course a board led by Jack Nasser, who was hardly a superstar at Ford. So these big companies get away with murder because people just assume that because they're running a big company they're implicitly a great manager, when so often that's not the case. And obviously Rio Tinto is another example, as we discussed Tom Lanese many times, equally as flawed in his decision making. So these guys get away with murder. It takes too long to get rid of them, and they get paid too much in the process. And their remuneration should be linked directly to shares and not on cash bonuses that are suddenly realised 5 years down the track to have never been paid in the first place.
All right, Peter Morgan, it is interesting. to be in that area is BlueScope Steel, and finally they seem to have some good news with a joint venture with Nippon Steel, which is Japan's biggest steel maker. Adam Schwab, did you have a look at this? Because BlueScope is saying, you know, this is the game changer for us. It's sort of like a phew, thank God this came along.
Yeah, if I was critical of Marius, compared to BlueScope's management, Marius is a genius, because admittedly you can't say Paul O'Malley is responsible for the high Australian dollar and other issues, but when a company's lost 95% of its value, and sure it's eked up a bit in the last couple of days, arguably I think 50% off a tremendously low base, but ultimately that company's been completely mismanaged. Have a CEO getting paid a $900,000 bonus while the company's had a $1 billion write-off is just disgusting. And Graham Cray-led board should be taken out and shot. I don't know what the hell they're doing there. This is arguably a good announcement from a shocking perspective. We're talking Pets.com almost. They've lost literally 95% of their value from what it was. So this company shouldn't be getting any plaudits regardless of what they've done.
Yeah,
maybe they're slightly better than they were a week ago, but they're still a disgrace.
Yeah, Peter Morgan, a couple of companies' results that we didn't talk about were, you know, Wesfarmers, but also carsales.com. You know, it's not a huge player, but very good results, and it's becoming a real media player, isn't it?
Yeah, I love carsales, along with Seek.
Have you got shares in them?
I don't actually. I should though.
Okay,
I haven't
that's fine.
Looked at them closely today, but
yeah, why do you love them?
I don't own any listed equities at the moment, but the car sales and the Seek businesses are just the perfect internet businesses, and they're essentially just lists, and that's the perfect business because there's minimal work, there's a little bit of sales involved, but there's a huge network effect, and you've seen that in car sales this last year, and that they've announced a profit increase by, I think it was almost 30 or 40%, up from 58 to 70 million. They've got a return on equity of 56%, which is phenomenal. And they trade on PE multiples obviously aren't the best indicator of a company's price, but they trade on a multiple of not that much more than a Wesfarmers or an Old School or even the bank. So what would you rather own? A company like carsales, an online business which is minimal risk and a fantastic network effect with growing profits and huge return on equity, or an Old School business that has 100,000 employees and isn't particularly well managed? Carsales any day of the week, and an amazing job by Greg Roebuck and the team, and of course they're not paid anywhere near the amounts of money that a lot of these other guys are paid, and Greg Roebuck's paid less than, we were just talking about Paul O'Malley. Paul O'Malley gets paid more than Greg Roebuck, so it's often the CEOs paid the least are the ones that get the best results, and Greg Roebuck at carsales is evidence of that. Interesting.
Peter Morgan, have you been watching this conversation about, you know, what is this, why is the consumer sentiment dropped, but the business survey was, you know, quite bullish?
In terms of consumer sentiment, I think the consumers are on the money. When you've got an economic cycle that's largely fuelled by credit creation, I've had 20 plus years of excessive credit creation, that excess debt and excess credit that's washing through the system has to be seeped out and expunged, and we haven't expunged it. It's still there.
But Adam, could I put to you, we've had 20 years of economic growth as well.
What's economic growth, Helen? You look at GDP, and we can crunch down what GDP is, and economists often don't live in the real world, and I studied economics extensively and always did pretty well at it, but I didn't believe in a word that I was writing then.
All right, so you reckon we've been in recession?
Well, look at what GDP is government spending. It's consumer spending. This is not going to create anything good in an economy. What creates wealth is investment. And sure, it's a function of GDP, but you can have falling investment, but high consumer spending and government spending, and it's leading to this headline GDP figure, or we can call it economic growth. But in reality, it's not creating a fundamentally strong economy and won't lead to higher living standards down the track. So we've had this massive expansion in credit, which has largely gone towards things like paying more for property. I know Scott disagreed with me early on, and we could argue for hours about it, but at the end of the day, Australian property prices on a yield basis are amongst the worst in the world. So the reason why property prices are so high, because banks have lent so much. Banks are lending 95, 100% of the cost of a property. So that money, instead of going to productive assets, or R&D or buying a tractor, it's gone towards buying someone paying more for a house in Surrey Hills. It's just a false positive signal. And we saw what happened in the US, we saw what happened in Europe. You can't create all this credit and have it just quietly seep into non-productive assets, and that's what's happened. Eventually that credit has to be expunged, and it hasn't been yet, and that's why I think a lot of consumers are sombre about where the economy could be heading.
Interested in what's happening to Facebook this week. I mean, you know, the share price is plummeting. They've allowed what the early investors to, you know, the ban on them selling has now been lifted. So it'll be good news for them, will it, if they sell some of their shares, but bad news for all the people post-float, won't it?
Well, it was good news for those who vended into the float at $38. And essentially, we need to think, and there's been most commentary you read is how the Facebook float has been such a disaster, but depends who you look. If you look at it from the point of view of idiot investors who bought into the float, it's been a disaster. But if you look at the point of a float is to allow insiders to sell out to outsiders, well, it's been a monumental success because the point is.
So what, you're sticking up for the insiders, are you?
I'm not sticking up for anybody. I think I'm simply looking and saying, was the float a success? In the definition of a float, you'd say yes. Would I buy shares in it? No. If you look at what Facebook's revenues are, they're pretty much all display advertising with a bit of money from the likes of Zigna. Looking at Facebook on a display advertising basis, they're worth about $5 or $10 a share, depending on how you view the effectiveness of display. Where Facebook's going to get a valuation of $20, $30, $40, $50 a share is if they can get search right and compete with Google, and that's based on perhaps people's personal preferences and information they've got, or if they get transactional right. And that's the two big ifs. They haven't got either of them right before. But for them to be a $100 billion plus company, they've got to get revenue from transactions. They've got to get revenue from search. They haven't got either of that.
Yeah.
So people buying into the float will either a long-term holder in the hope that Zuckerberg can do that, or they just have no idea what they're doing, which is probably the case for most people.
Okay, we are going to take a very